Hello, everybody. We're going to wait just a few moments to get started. Hey, Michael, just out of curiosity, how did you find the group today? Did you find it through meetup.intel.com? I want to make sure that everybody's got the same link here because I'm surprised there's only two of us here so far.
Yeah, I found it through Meetup.
Okay, great. So
Yeah.
people from Meetup will come in this way. Let me
I just got it yesterday, I think, the notice
Okay,
about it.
let's see. And let me make sure our speaker has got the right link. I'm sure he does, but I just like to double check these things when it's almost noon and people aren't here.
Oh, okay. Well, it's almost 3:00 where I am, so.
Ah, there you go. Let's see. Oh, you're ready to almost wrap up the day here.
Yeah, yes. They're always later in the day for me, these.
That's actually probably pretty nice. I try to schedule them at lunch hour just because I assume people will probably be open at lunch. Oh, West Coast. But
Right, yeah, West Coast, yeah. Are you in the West Coast?
yeah, I'm over at
okay.
the Jones Farm in Hillsborough.
Oh, okay. I'm in Hudson in Mass.
There we go. We're getting Hey, Jeremy, good to see you there.
Just on time. It's
I
exactly
was
noon. Sorry.
just checking the links to make sure that I had sent them out correctly because usually
Yeah.
we've got a few more people in the room here by now.
Okay.
Let me double check on our registrations. By the way, Jeremy, it's good to see you face to face.
Oh, that's true. I'm a big phone guy, so good
Yeah.
to meet you in person here.
All right, we're getting a few more people in. Let's see, we have 170 people registered.
All right.
And we tend to get about half of that, I would say, somewhere in between 50 to 60%. It's been trending at like 55% recently.
Okay. If just if we need additional time past the hour, I have it. So whatever you guys need.
Okay. Yeah, I'm happy to let that go on here. I know people at Intel are usually on a half-hour schedule.
Yep.
So
yeah,
people will start disappearing for their 1 o'clock calls there.
I get it.
Hello, welcome everybody. As you're filtering in, good morning, good afternoon, good evening, wherever you happen to be. I always love seeing John Doe here. I'm always curious who he is. A security conscious person, but he asks good questions. Welcome, Bob. Welcome, Satish, Brian. A lot of you people I recognize. We're going to get started in just one moment. While we're waiting, why don't you guys throw out some potential topics for future speakers? What do you want to hear about it, particularly as we're getting towards the end of the year and we're looking at next year? I know that I'm beginning my goal setting for next year, and I'm starting to think about how I want to change and how I want to pivot in the next year. And as we're going to be talking to Jeremy, I think there is a lot of reason to pivot in today's market. We should always be constantly reevaluating our business plans and our portfolios and building based on our current goals and our current best set of knowledge. And that's why we're here today, to learn from great speakers like Jeremy. So I'll stop talking. If you guys have any suggestions for future topics, go ahead and shout them out or put them in the chat. And we'll get started 5 minutes after.
I was gonna make an Intel joke to start, but I think that's a very bad idea.
Depends on whether it's a good one or a bad one.
I'm just kidding. I actually love Intel. Been using Intel laptops forever.
Yeah, actually, I sent you our HR guidelines. The only thing you can't make jokes about is our competitors.
Oh, interesting. Really?
And they didn't actually rule out Intel jokes, oddly enough.
Wow, interesting.
Echo
Yeah, it's
just
kind of
for
funny.
guest speakers or for Intel people?
What's that?
I said, does the jokes about our competitors only apply to guest speakers or to anybody?
Oh, that's a good question. I think it's anybody. I would err on that side.
Yeah.
I do get a lot of like comments when I talk to real estate people, and I'm saying, hey, you can't say anything bad about AMD. They go, oh, okay.
Well, I mean, I'm trust me, guys, I'm not the guy to be buttering anybody up, but think about, I don't know how many of you have been with the company for a very long time, but think about how different the world would be right now if Intel wasn't pushing all the tech. Like I'm talking, into the 90s, 2000s, and how everything advanced as a result, even competitive, but just think about how things would be different. It'd be just massively different, I think. So I'm personally thanking you for all your work because it, affects my family and I. So thank you.
Thank you. All right.
And I'm personally thanking you for buying laptops. Feel free to buy many more as well, and whenever you want, as fast as you want.
Who says he's using laptops? Maybe he's buying servers.
I actually, long story short, is that I think they were Xeon chips way back when, but one of the things I did as an investment, in fact, a friend of mine owned a web hosting company before AWS back in the 2000s, and I probably bought 70 to 80 Xeon servers that I leased to him as a leasing company, so to speak, as a 3-year type of investment. So I did buy a lot of stuff at some point.
All right, we're going to get started. Jeremy, it's really great to have you here. I've had a couple of good phone conversations with you, and I'm going to let you say exactly what your role is right now, and I'll actually let you introduce yourself because it's a little more unique than some of the people that we've had in here. A lot of the people we have in here, they have their real estate business and they're running it, and they're looking to get their message out, but they're going to do it through an educational fashion. And conversations that we have had have been a little bit different. So I'll let you introduce yourself, and then we can take it away. If you have questions, feel free to put them in the chat, and I will judiciously interrupt Jeremy and ask them.
Yeah, no, thanks again for having me on. Thanks everyone for being here. So I probably am different than most of the people that attend, I guess. So I truly have nothing to sell anybody on this call. I'm just trying to be helpful, have the hour to spend. I'm happy to do it. So my name is Jeremy Roll. I'm originally from Montreal, Canada. I grew up there, did undergrad there, spent half my life there, and then moved to Philadelphia, did an MBA over at the University of Pennsylvania, or the Wharton School, graduated in 2000, and then moved to LA then. So I've been in LA for about half my life, and now I'm in Irvine, which is just a suburb basically of LA, an hour south. And so I've been in the US for half my life, in Canada for half my life, and on the investing side, and I spent over 10 years in the corporate world. I should let everybody know. The last 2 companies I worked for were actually Toyota headquarters was the last one, and Disney headquarters was the one before that. So I'm very familiar with being in the shoes you guys are in, working with at a big company. So from an investing perspective, I was investing. It's funny. I was investing in my Disney Fidelity 401k plan with everybody else at Disney at the time, at Disney headquarters back in 2002. And after the dot-com crash, I just got sick and tired of 2 things with the stock market. The first was the volatility. So watching it go up and down 30% a year is just not a good fit for my really conservative personality. And the other was a lack of predictability of where my retirement account was going because of all that volatility. So for me, just not being able to say, okay, in 10, 20, 30 years, this is where I'm going to get to because of the volatility in the stock market really bothered me. So I started to look for different ways to invest for more predictability, essentially. And I came across the concept of syndications or managed opportunities, basically when they're pooling a lot of investors together and you're a small piece of a bigger deal that someone else is managing. So you're completely passive, right? And then I honed in on cash flow or more stabilized cash flow type of strategy for myself because I'm lower risk and I was looking for that predictability. And I realized that might be a really good fit for me from a predictability perspective. So I started to rotate my investments from stocks and bonds into passive cash flow, call it, Some of it was real estate, some of it was non-real estate, like I mentioned before, like the servers was an example. And I ended up rotating all my money from stocks and bonds into cash flow between 2002 and 2007. And what happened in 2007 is that my intention was not to leave the corporate world with the cash flow. In fact, I just wanted the paycheck, the W-2, and I just wanted a more predictable cash flow, more predictable retirement structure long-term. And I had a last straw moment in the corporate world with one of my managers at Toyota headquarters. I just moved divisions, and I won't get into the story, but long story short is that I decided to leave the corporate world in 2007 and take a risk because I had built up enough cash flow to live off of, even though that wasn't the intention. So I've been a passive cash flow investor for over 20 years, since 2002, and a full-time passive cash flow investor since 2007. So since 2007, I've been out of the corporate world. We can get into some other stuff I've done. I co-founded a nonprofit to do with, helping investors, this network. I have my own investor group. That's something I don't typically discuss on something like this, but my primary focus is literally just full-time on finding investments for myself. I'm heavily diversified. I just love diversification. So I'm in over 60 different LLCs actively right now. I've been in over 150 to 200 over the past 20 years. And I'm a huge fan of cash flow and predictability, and I've always kept the same strategy. So over 20 years now, I've never invested in a construction or development type of opportunity, as an example. I go with what's the best fit for me. And I also have stayed passive the entire time, even though I got out of the corporate world, had the time to be active, because I found it was the best personality fit for me. And so I just kept going down that path. So anyway, so I'm happy. Honestly, it's like an ask me anything situation here. I'm guessing Daniel has some questions for me, but any way I can help anybody. I was, in the corporate world for years, over 10 years. So I can relate to what you guys are going through. Wasn't an engineer, I was in marketing, but still. Anyway, happy to answer any questions.
I'll throw a couple out here, and if you have questions, feel free to put them in the chat. Jeremy, what was it like when you first started investing passively while you had your W-2? How much work did you put into it at the time, and how did you balance that?
Yeah, so, it was a very different time, because technology now with crowdfunding websites and a bit of changes in the laws have made it easier to find opportunities today. It's still not easy, okay? But it's easier. So I was lucky because I was living in Los Angeles. And Los Angeles being a big city, I went onto meetup.com, which is a great resource for those of you who are not familiar with it, to find public meetings. And now this is before I was married and before I had kids, and I could choose to take the time after work. So I went to about 2 to 3 meetings on average a week for about 5 years, which is a lot. It's a lot, especially driving in LA. It was a commitment. And I did that because the main way I still find opportunities today, unfortunately, is through networking. They did change the laws in 2012, and it came into even more effect in 2015 to allow for more public marketing. But even today, I'll tell you, the vast majority of deals I find today that are the good ones are not publicly marketed. So back then, I did a lot of in-person networking. I frankly went to a lot of meetings that were sales pitches, which I hated. And I would sit through 2 hours of them, and I literally bring work from work, sit in the back row with my BlackBerry and my portfolio, and I would do work for 2 hours, not listen to the sales pitch, but then know that I'd be able to network after in a pretty large crowd, right? And so that's what I did between 2002 and 2007. When I left the corporate world, I actually started my own meetings. I said, why am I wasting my time here? I've got no work to do now. I'm like, literally the first meeting I went to after I left the corporate world, I was like, oh man, now I have to sit through 2 hours and I don't have work to do. And so I started my own in-person meetings called For Investors by Investors, that were there's a nonprofit. We're just trying to break even on the cost of venues, bring investors together, network, and learn in a non-sales pitch environment. That still is actually active today. It's the largest kind of public non-institutional real estate meetings in California. I don't know the exact number. We have over 50,000 registered users for sure, probably more. All of our active meetings are in Southern California and out of state, none in Northern California at the moment. But anyway, sorry for that's the long answer.
Hey, tell us a little bit about your group there. What's the primary purpose of it, and why are people attracted to it?
Yeah, so the primary purpose was to unite people. People could come to a meeting and know that they weren't going to get a sales pitch. We heavily screen the speakers or panelists. We don't typically take anyone we haven't known for a long time. As a result, any chapter leaders we've known for years before we allowed them to become a chapter leader. We're very protective of the brand. And our goal is just break even on the cost of the venue with some type of interest fee, and have people know they can go to a meeting where they're not going to have a sales pitch, because it just bothered me so much that I did that for years myself. So it was a bit trying to help the community to avoid a sales pitch, bring people together, network, et cetera. And so I actually managed 2 meetings a month myself until about 2011. my younger son had a major health challenge. I had to stop managing that meeting and never really picked it up again. But we currently have a whole bunch of active chapters across different chapter leaders.
Okay, and we've got 2 questions that just came in from the chat, and one of them ties into that work balance lifestyle, and I'll get to the other one, which is heading towards the economy shortly thereafter. But John Doe's asking, with involvement in so many LLCs, how passive can you actually be? How much time do you spend managing your investments these days?
Great question. I should preface everything here by saying I'm not an investment advisor, financial advisor, accountant, or attorney. So anything I'm sharing here is just my perspective as an investor. So I am what I call hyper diversified, over diversified, which I do not recommend, so to speak. Okay. Most people who are investing in this stuff that I know are typically targeting to be in 10 or 20 opportunities. What tends to happen when you're doing this for 15 years full time is that you end up networking a ton and finding all these different unique opportunities. And then you're having to reinvest money as they exit, and you've got more and more opportunities. And so just almost organically, if you spend a lot of time networking, you end up getting into a lot of opportunities. So the management of the opportunities isn't that bad because I'm passive in everything. I get, let's just call it on average, quarterly reports, quarterly cash flow checks, and I have to see how those are doing and sometimes speak to the managers to understand if there's a problem or not. But at the end of the year, the biggest challenge I have is that I get a bunch of what's called K1s, which are tax forms they have to provide to you that you submit to your accountant. And they actually summarize all of the tax implications. So it's literally typically a couple pages and it's already done for you. Now, the challenge is that I never get my 60 plus K1s on time to file on time. So I'm the kind of guy that would, if I had a choice, I would file on time every year. I'm very organized, but I always have to file an extension and I chase K1s all the way until August. Typically, that's when the last ones typically come in. Deadlines, I think mid-September. And so that's a bit of a pain, and that is what it is. But generally speaking, the management of it isn't that bad because someone else is managing everything. And I have to make sure I'm getting the quarterly cash flow payments. I have a spreadsheet to monitor who I should be getting payments from when. I have to compare what they're projected to be versus what they are. And if they're way off, I say plus or minus 20% plus, then I'll look into those further. But the management of it is not as bad as you would think. It's more about finding more and more opportunities to reinvest the capital when stuff exits. Or if you have incremental cash flow beyond what you're living off of, did you have to redeploy that? So I work very hard. I want to make clear, everybody, I work very, very hard.
Do you tend to just stay within a certain set of operators that you use repetitively over and over and over, or do you bring new operators in and out all the time? And what's your process for doing that and screening?
Yeah, absolutely. It's both. My favorite situation is when I found an operator I really like and I'm able to kind of double down on them. But the problem is that you don't want to put all your eggs in one basket, right? So I tell everybody that the concept I believe that I follow is that I trade control for diversification by being passive. Because when you're passive, you have no control. Even if there's some voting rights, you're such a small percentage, your vote is kind of meaningless, right? Almost. So I'm giving control to somebody else. But in exchange for doing so, I better benefit from the diversification, and I have to diversify across asset classes, geographies, and operators. Okay, all three. So I would not choose to put 25% of my net worth into one operator, for example, no matter how much I like them, right? So that's one thing you have to be very careful with. So I'm constantly reinvesting with operators that I like, as well as trying to find more operators to stay properly diversified.
Just a quick note, for some reason your video has frozen on our side. I don't know if you could turn it,
oh,
turn it off and turn it on again.
Well, hold on, let me try, because I actually have a very new laptop. I have a ThinkPad T14S. It's like a really good laptop. Huh. Okay.
It's probably
you know
more
what?
a bandwidth and
No,
software issue.
it's not, because I actually have Google Fiber. So it's saying cannot fail to start the video camera. Please select another video camera in the settings. So I would probably have to reboot, unfortunately. This is a Microsoft Windows potential issue without disparaging Microsoft. So let me actually,
all right.
let me see. Let me just try one more thing. Okay, I have a backup camera, which I could get if you guys want to give me a second. I can plug it in. I've never tried it on this laptop, or we can leave it like this. Would you like me to try a backup camera?
If it doesn't take more than 2 or 3 minutes,
yeah,
go for it.
We keep talking because you might hear me. It's very close to me, so you might hear me in a little bit of a distance. But okay, so keep going with the questions. I'll try to resolve this.
I was going to say that it seems like a lot of questions are around how you select your operators. Glenn has just asked, for 20 years, you have a long set of, I'll repeat these all for you too.
Sure.
For 20 years, you've got a long set of data. What percentage of your deals went bad? That's a great question. How many operators do you keep in parallel? I have specific questions on just what are your criteria for selecting an operator?
Yep. Okay.
Yeah, and more people here, feel free, since our speaker's getting his camera ready, feel free to take yourself off mute, and if you have a comment, go ahead and throw it in here as well. What would you like to hear from somebody who invests in other people's deals full time? And Jeremy, I also believe you manage other people's money and invest on you invest in operators with other people's money as well. Correct me if I'm wrong about that.
Yeah, that is actually not correct. It's
Okay.
Let me just explain that to people because that's important. Sorry, I'm just trying to plug in. I've tried to plug in my backup camera, which I've never tried on this laptop, in 2 different ports. And
You know what? We'll let you do that. If other people have any other questions, take yourself off mute and just go ahead and ask them.
okay, guys, I think this is not going to work. I think I'd have to I don't know what happened, but my Zoom is not happy. I mean, I have one other option, which is I could try to exit Zoom and log back in if you like. That's the last thing I could try.
Let's just keep going. I'll
Okay.
find a picture of you and I'll put it up.
Okay, very sorry. This is the first time it's ever happened with Zoom. So, okay, let's get into those questions.
All right, first one here. For 20 years, you've got a long set of data. What percentage of your deals went bad?
Yeah, so I have a bit of an unfair advantage with that, only because you got to remember, I tend to target like 99% of what I focus on is low risk, passive cash flow. And just to kind of define that a little bit better, let's just take real estate as an example. I'll typically invest in an 80 to 100% occupied building that's stabilized, may or may not have any value add upside. I just want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I'm already starting with basically, what I like to call a brand new airplane, right? With all the new technology. And in order for it to crash, 6 dominoes have to fall, right? Whereas if you're like 6 systems have to fail. Whereas if you're in a 50-year-old airplane, one thing could go wrong and then you may crash, right? That would be like a construction deal, right? In the highest risk level, for example, or a land deal. So I'm already starting off with the higher probability of success based on what I target. I have had, let's see, I could tell you stories if you'd like, because I've been in so many deals. So I've only been in one foreclosure ever. It was actually a fascinating story where I didn't even lose my equity, which I know sounds crazy. So I'm actually still in a different property as a result of that today. I've lost about 20% on something called factoring accounts receivable financing, which was kind of medium risk, which I don't normally do. And that happened as a result of the last downturn in a business, having major challenges because of the last downturn in 2008, 2009. I've been in one situation where there was a partner dispute between 3 partners for a fund that was buying, rehabbing, and renting homes. 2 of the 3 partners, who were the real experts on the ground, ended up leaving basically, and they left the one back-end office guy in charge. He was just no clue how to manage homes. So I actually stepped in, negotiated getting all the homes back from him, brought a new operator, and we ended up breaking even, which is not good in like a 3 to 5 year timeline because you're basically losing money to inflation, but not a disaster. I've actually been in one scenario where there were 3 partners, a father and 2 sons. They've been doing this for like literally 30 years. I was childhood friends with them. As it turned out, the father was taking very small amounts of money out of the business each year with nobody knowing, out of all the properties. Very minor, to the point where the returns were still correct on the property. They just weren't outperforming. When they found that out, basically there was a change of the managers. There was a receiver brought in to protect the investors, and no bankruptcy or anything like that. The properties were still performing, and then the new manager came in and is currently, we're getting cash flow from that. So the one big challenge I had was when I was in a foreclosure, but even that story resulted in me actually getting transferred to a different property from equity, which I still get cash flow checks every quarter today. I can get into a lot more detail of any of these, but those are like 4, maybe 5 examples out of 150 to 200. So that's really what the percentage is. I'm not, except for a couple of startups I've invested in that's gone to 0 back in the 2000s, which are clearly a different risk profile. It's like 1% of what I do. That's all that's coming to mind on the cash flow side.
That's a good question. Is the majority of your portfolio, is it real estate, or do you diversify into, businesses or other forms of commodities or
Yeah.
assets?
So I strongly prefer to be in hard assets. That's my favorite, just to have that asset-based investment for security. But I do invest in some cash flow-based businesses as well. So for example, I've been investing in ATM machines since 2008, which essentially, as you guys know, are computers that depreciate to almost zero, right? So that's when you're dependent much more on the cash flow and you're looking for a quicker return of capital to reduce the risk because you don't have that hard asset to make a bet on. So it's a combination, but I would say the majority of what I'm investing in is typically one form of real estate or another. And I should tell everybody, it's not, I'm not typically invested in just in single family homes. I do have single family home investments, but it's typically going to be what I call commercial. And so I'll give you guys just an example of what I'm currently invested in. Mobile home parks, self-storage, RV parks, apartments, student housing apartments, senior housing, office, retail, industrial. I do not invest in hotels. And then also, I normally invest in lending money to single family flippers, but I stopped that earlier this year because of interest rate increases. I was completely out of that in June, and I'm probably going to go back in once we get more of a stabilization of interest rates and stuff and prices. I've done been invested in home flips and buy and holds of homes. I'm not in any of those right now because of the timing. And then I have, like the ATMs and some other stuff too. And I have a handful of startups, maybe 10. Those are very unique situations where I just have to make a bet on someone I know. And I like the business plan well enough, but it's very rare. I don't look for startups. I don't read startups. I have to make a bet on a very unique person that I know.
So you mentioned single family homes. Do you only get involved with them on a debt side, or do you actually take in equity and work with operators on an equity side?
Yeah, so when I'm lending to flippers who are like, it's going to be in a first position loan debt side. Otherwise, it's typically going to be in the equity side. I prefer to be invested in equity in all these managed opportunities versus debt, which, there's 1,000 ways to invest. None of them are wrong. So this is just the way I do it. Everybody else could have different ways of doing it, no problem. But I essentially prefer to be in equity because I typically invest on the lower risk side of the spectrum. So I might as well benefit from some equity upside if I'm already going on the low risk side of the spectrum, because normally if you're going to debt, it's to reduce your risk. So I don't like to be in debt as much because the returns will likely be lower than the equity side, all things being equal.
Okay, that's really interesting. So there are a lot of people here that I think like single family homes. How do you structure a partnership with somebody that you're financing for the single family home where you are providing equity? How do you structure your deals?
Yeah, so you're talking about a single family home flip?
Single family home. Whatever you do, if it's a flip,
yeah,
if it's,
Yeah. So so the hard money lending, which is kind of the slang term, is when you're lending on a first position as the lender. So you're in the first position loan. So that's debt. I do that when we're either in a pooled fund, where again, it's a fund that owns many different of these, and they're pooling all investors together to do a bunch of these. And they're constantly turning the money over to new loans. I also do those individually, which is very rare for me, where a friend of mine who's flipped over 1,500 homes, he will allow me to kind of co-invest in a single property with him. I don't like that from a diversification perspective. So I'm normally invested in, let's say, 5 to 10 properties at once, but individually on each one, where I'm actually a partial first position that's actually, properly registered as a first loan publicly, right? So that's how I do that. If I'm investing in a single family flip or buy and hold, it'll be on the equity side, where I'm typically pooled together with a whole bunch of investors, like any other type of fund that owns any type of property.
Okay, so that's interesting. So you do it in terms of a fund where you're pooling other people's capital and putting it into purchasing houses. And are these houses that are specifically to be flipped, or are you holding them at all?
Well, I've been in both. I've been in funds that were designed to be flipped. And I've been in funds that are designed to be held. I want to point out that I don't do any of this myself, right? So I'm just a passive investor in something else that's being done by somebody else who's managing it. And Daniel, I want to go back to the question you asked where I got thrown off by my camera. This is really important. I do have an investor group, but I don't pool anybody's money. I never have. I've never even formed an LLC myself in my life. I have an S corp for my own consulting. Most of the investor groups will actually pull people together into an LLC and then invest as a single LLC into an opportunity. And then they take a portion of the profits or a spread or what's called a promote and maybe some type of management fee as an intermediary. What I do with my investor group is it's a very secondary focus for me. I send a very small subset of what I'm investing in. I'm very picky, and people can just choose to invest directly with a sponsor under the exact same terms as me. I don't take anyone's paperwork or money. We're all investing under the exact same terms. People have to sign a waiver and consent agreement that they won't pursue me if something doesn't perform to projections, because I literally have no more control over the outcome than anybody else who's investing in it. We're just investing under the exact same terms. So that's a secondary focus for me. I just try to help investors with that. Helps with my networking as well, honestly. But I'm not an investor group in the traditional sense. I have no employees. It's not a focus of mine. So I just want to clarify that I'm definitely not investing or pooling anybody's money at any time.
Okay, great. I've actually met, I know that's actually fairly common amongst doctors, or at least I know of several doctors groups over at Kaiser Permanente that do the same thing. They just all evaluate passive deals together, and if they like them, they can individually choose to do or not do it.
Right.
Okay. So amongst the different assets that you just mentioned, which are you most optimistic about in the current market environment?
Oh boy, that's a great question. So really, the only thing I'm optimistic about right now is investing in a cash flowing situation that that has a higher probability of doing well in an economic recession, where I do not have to worry about the asset value reducing or depreciating, or because of adjusted values based on an economic downturn. So meaning that I think all the major asset classes are at risk because interest rates have gone up. I think that the profitability from these deals are also going to go down, because during a recession, what happens, I'm just going to use apartments as an easy example that everybody probably can understand. Vacancies go up, rents go down. By the way, this is during an inflationary period where expenses are still going to go up, profitability shrinks. So you're going to have two headwinds against you. You're going to have shrinking profitability as a very high probability, and you're going to have reduced asset prices even without the shrinking profitability, because interest rates have gone up and people are paying lower multiples for the same property. If those both happen together, it's compounded, right? And I think that applies to pretty much any asset class I could think of. Why none of them are immune to interest rate increases and the possibility of a recession hitting them, right? Some will handle recessions better than others. So just to give you an example, mobile home parks, self-storage, those tend to do better during a recession, depending on the location, depending on who they're targeting. But if you do it the right way with the right strategy, I'm not saying they won't have a reduction in revenue, but it'd be less so than some other potential asset classes. And so what I'm doing is trying to avoid all that by waiting at the moment. In the meantime, I'm just going to use the ATMs as an example because I know them really well. I've been investing in them for 14 years now. I went through the last downturn. I started in January 2008 with my ATMs, and they were down about 15% of revenue, but because there's so much profitability, the return for investors really wasn't affected. And they're going to depreciate to zero like we talked about before. So I don't have to worry about the asset depreciating. I already know it's going to happen. I don't care if it happens more quickly, right? There's a projected 5% residual value, so almost all of it's gone. I'm more concerned about, is it going to cash flow well during the downturn? And I've seen from the past downturn, it did pretty well. So I'm pretty, higher probability thinking that it's going to do well. And again, another downturn. So that's something I did invest in again this year, or I would invest in right now. And I have done in the past month or two. That is less concerning to me. So right now, my biggest concern is a reduction in asset price value. And I think that almost everything is subject to that, including in the stock market, more pricing down, including all major asset classes.
All right. In terms of questions here, I'm going to hit Anna Maria's and then Ashish's and then Mark's. But if you have questions, feel free to put them in the chat. And actually, before I do Anna Maria's question, what sort of debt are you looking for in your properties? Are you looking for long-term fixed? Are you looking for floating rate with a cap? What are your debt metrics? Great
question. So because I look for predictability, I look for a long-term fixed rate loan. So I've actually never invested this. Well, there was one deal I invested in this year with a floating rate. It was literally 20% loan to value industrial cannabis deal. Very unusual, very unusual, very unique. Someone I've invested with before. The only person I do in this space, right? So very unusual, very low loan to value. I have not done one floating rate deal that, most of the apartment deals in the past years were floating rate. Didn't do one of them because I look for more predictability. And that is a lack of predictability of where's interest rates going to go. How's that going to impact the opportunity? It's not necessarily as low risk, as not more as predictable as what I'm looking for. So I tend to favor a 10-year fixed rate loan when I invest in properties. And that's what I look for as a baseline. By the way, I just want to go back to just one more thing, Daniel, on the previous question, which I should have mentioned. One of the things I am doing right now with my cash in terms of what I'm investing in today is I am putting some cash into short-term treasuries, like 3-4 month treasuries, bought some again, I think 2 days ago. They're yielding about, I got 4.45, I think, this week. Really bad, because like at 4.45, you're not, you're definitely not keeping up with inflation. And we can get into this too, but the published inflation probably isn't the true inflation for various reasons. They've changed the way they calculate inflation 20 times since 1982, and it's not random, and it's not, it's not a coincidence. So if you look at the way inflation used to be calculated pre-1982 and was probably a little bit more accurate, you're looking at about 2x the published inflation rate right now, about 15%. So getting 4 or 5% isn't great, but it's better than having the money sit in the bank while you're waiting to see what's going to happen. So I just want to throw that in, Daniel.
That's an interesting strategy. All right. So Anna Marie's question: what advice would you give to a new investor who is, I'm sorry, what would you advise a new investor to invest in the coming year?
Yeah. So what I would advise a new investor to do is to spend the current time developing their own opinion about, because real estate and the economy are both cyclical. And if you're not going to take that into account in what you're going to invest in your investing thesis, you can really shoot yourself in the foot. So I'd advise an investor who's brand new to come up with their own opinion about where we are in the economic cycle, where we are in the real estate cycle, and then to determine when they think the right timing it is for them to start. Because right now I can tell you, unless it's a very unique opportunity, and I could share some stuff I've invested in recently that's been unique, but unless it's really unique, I am personally waiting on the sidelines, waiting for prices to adjust, because unfortunately, unlike the stock market, real estate adjusts slowly. That always happens. And, all the interest rate increases, they take a long time to be digested by real estate and the economy. And so I think you're going to see a lot of the price adjustment in real estate and the economic downturn next year as everything's digesting all these interest rate increases. So I would tell someone to be very cautious if they're starting right now, formulate their opinion about when they're comfortable jumping in based on their own opinion about where the economy is in the real estate cycle. But I do think it's going to go from the worst time to invest, which is right now, to the best time to invest, probably within, if I had to guess, 6 to 18 months. Real estate goes slow, and I'd rather be a little late to the game than early to the game, because you don't want to catch a falling knife of prices. Prices don't just revert and shoot up again very quickly. That's not the way the end of a cycle and beginning of a cycle work. So hopefully that's helpful.
Yeah, that's very helpful. And I think that's actually, that advice is in line with quite a few of the other people we've had here, which is good to know that there's a somewhat of an alignment amongst active investors in the downturn, and then how long that downturn might possibly last.
Yeah, and can I just make a comment? I just saw a chat comment just pop up on my screen. I think Ashish added this. I think he added a link to something. So just note, I've invested with more than one operator in ATM. So whatever link that was, which I didn't even see, it's not the only ATM opportunity I've invested in, just to clarify that information.
And Ashish, I know you've given me a contact for an ATM person, and I'm trying to get them on.
Okay.
All right. I don't know if that's the deal from them or not. Let's see. But going actually up to Ashish's question, which is further up, which was next. With thousands of available sponsors, how do you narrow it down where you source your investments? Can you share some of your favorite sponsors and investments?
Yeah. So narrowing down, we could literally discuss for like an hour or two. So I'm just going to give you guys the really high level of what I try to do. So first of all, what I've learned over the years is that the more defined you can make your box, or basically your criteria of what you're willing to look at, I think the better off you're going to be as an investor, because you're going to waste less time focusing on the wrong things. So I've narrowed it down to a pretty small box of what's going to fit in my box that I will be willing to invest in. So that's always helpful as I'm weeding out opportunities to start, right? We can get into the details about that, but I'm just getting you guys high level. So what fits with my personality and what I'm looking for, and again, there's 1,000 ways to invest, none of them are wrong, but what I'm looking for is more predictable, more conservative type opportunities. So I'm going to look for an experienced sponsor, because I want to avoid someone who's learning off my money. I know it doesn't sound good, but it's kind of true. When they're brand new, that's what's happening. I'm going to look for someone who's using conservative projections, who's targeting the same markets that I'm open to, who is looking to underpromise and overdeliver by using very conservative projections, is a very conservative person themselves, and is looking to build long-term relationships with people as a result of the assumptions they're making in those projections. And I'm trying to avoid someone using very aggressive numbers that look great to investors and attract investors, but is a big marketer, is getting out there using aggressive numbers, may underperform because they're using aggressive numbers, but they don't care about building that relationship with me because they're just going to go to the other investors they find through all their marketing and their outreach. And so I'm not saying that just because a sponsor markets a lot that they're a bad sponsor, but if you combine that with aggressive assumptions, I definitely absolutely stay away from that. And I stay away from anyone using aggressive assumptions to begin with, because it's not the right fit for me at all. And so I'm trying to find someone who is on the same mindset as me. And then I'm also trying to align that with the property and the business plan that align with my own strategy, which may be different than yours. And I also want to say one thing I do without fail is I always do background checks on people, and I find most investors don't. It saved me several times over the past 20 years. Always run a background check on all of the managers of the managing member entity of what I'm investing in. So all the people who have control, that just to be sure nothing odd comes up. And that's a very big rule. And I tend to not invest with somebody unless I've met them in person at least once to do a final gut check. It usually will happen at a site visit at a property, but even if it can't for some reason, I don't like the idea of investing with someone unless I met them in person once to do a gut check. You know, even if I've done Zoom or whatever, I still prefer to be in person with them.
All right. You just hit the magic word here for the next question, which is mindset. And I think this is a question a lot of people are going to be interested in. Do you see a major mindset needed to transition from a W-2 employee to the phase that you're in? So tell us about your mindset transition and the importance of mindset.
Yeah, really great question, because I was on the phone with someone 2 days ago who was a vice president of a very large publicly traded pharmaceutical company. And he's trying to do this type of investing. And he literally said to me, I just can't get away from this compensation packet. I said, great, well, don't then, if that's the right fit for you, right? So this type of investing isn't necessarily the right fit for everybody. And I also want to say that there's a lack of liquidity in this type of investing compared to buying a share of Intel, for example, that you can buy and sell anytime and get the money in 2-3 days based on settlement. So you just have to make sure this is the right fit for you. There's pros and cons to this type of investing. So I would say that for those of you who are brand new to this, who don't understand it well or are wondering about the mindset piece, the two best books that I can recommend would be by Robert Kiyosaki, Rich Dad, Poor Dad, and then Cash Flow Quadrant. And for those of you who read Rich Dad, Poor Dad, but have not read Cash Flow Quadrant, I'd still recommend reading Cash Flow Quadrant, and I recommend reading the books in that order. That describes basically the mindset, gives you some things to think about, going from being an employee to someone who is either a business owner or investing in companies passively. And I did not read those in advance to deploy my strategy. I did what I thought was going to make the most sense. And I read those after the fact and then realized it was pretty much what I did. But I think that those two books, and by the way, I'm not a book reader. I hate reading books. I'll listen to podcasts. You know, I'm just not, I'll read an article, but it is worth the time. Those are easy reads. They're not long reads. The one thing I will say is that there's a little bit of repetitive writing in there and the books overlap a little, but still try to get through them, because you know those books have been life-changing for some people.
Yeah, I have to agree. I was buying and selling single family homes kind of early on because my family was had a history of doing that. And after 2008, I ended up with just a rental house that I rented out for a long time, and I felt really burnt out on real estate. And it was reading Rich Dad, Poor Dad that kind of motivated me to get going again. And I think those two books are the most widely known books amongst real estate investors, and they're definitely worth a read for anybody interested.
Yeah, I think that Cash Flow Quadrant is overlooked a little. Like everyone's heard Rich Dad, Poor Dad, but a lot of people have not heard of Cash Flow Quadrant. That is another book that is specific to how this all works and mindset combined, and it's just a fantastic book.
All right. A couple of people are asking, what is an ATM investment, and can you explain the business model of it?
Yeah. So try to do this quickly. So I'm sure all of you are familiar with, you know, you go into a Bank of America machine or a Wells Fargo machine, you take money out, right? Any bank, Chase. What happens is that those banks are actually, it's illegal for them to have their own ATMs in most locations. And what I mean by that is that they can have them in malls, they can do certain things, but it's illegal for them to go to try to make transactional money off of people as a general philosophy. They're trying to serve their clients. So you'll have smaller and some large ATM operators who will go to, let's say, the mom and pop coffee shop, who you'll find at the nail salon, who you find at the barber shop. And in some cases, even in much larger locations like the airport or the 7-Eleven chain, you know, if you walk into 7-Eleven. So those are a business and they're very profitable. There's two different components to the revenue for those. One is the obvious one. When you go up to one of those machines, they warn you there's a $3 or $4 charge or whatever it is in your area. Are you okay to proceed? You click yes, and then they charge you that fee. Sometimes your bank pays you back, sometimes it doesn't, depends on your account. The other piece has to do with like almost like a bonus for volume of transactions that the processor will pay you, and that's a separate fee. And so those two pieces come together to form the revenue. It's on a per transaction basis. And you know, some areas are very competitive. Like if you go into Manhattan in New York, right, you'll find an ATM at almost every location, and those are still viable because there's such a large population and so many people walking by as traffic. Whereas in smaller cities, there won't be as many necessarily, but they're still going to be in the trafficked areas like the gas station, like the 7-Eleven, maybe the grocery store, that type of thing. And so you can invest in those. They're not so easy to find. And you would basically be sharing in a portion of the profits, almost like you're an investor in any business. And so that's the basis for ATM, where you're getting a portion of the profits from the transaction revenue. I want to warn everybody that I find the ATM area to be very dangerous to invest in. I started investing in 2008, started to research some sponsors, quickly came across, if you Google ATM Ponzi scheme, you will find many, okay? I have personally identified since 2008, 3 deals I was looking at that as I did my due diligence, I said, this is a Ponzi scheme. And then they were all broken up by the government after the fact. One of them was one of the largest Ponzi schemes in Southern California. I came across it in 2009. I'd been going since about 2000. I said, this is a Ponzi scheme, most likely. It got broken up by the government in 2017. I didn't report any of these. I was frankly scared to. It was a multi-$100 million Ponzi scheme for the one in Southern California, for example. So you do have to be very, very, very careful investing in ATMs. We can go into a lot more detail about how you mitigate some of that risk, but I just want to make sure everybody knows that.
Yeah, what tipped you off that they were a Ponzi scheme?
Well, the real story for the funny thing is I happen to live about a 25 minute drive away from the headquarters of this ATM company, and the big one. And I got the opportunity, and then it was like a kind of a sales email, like, oh, we just got a new package of 500 convenience stores. These are going to go fast. You have to invest now, right? So I called up the company. I was referred to them by someone who invested in it. And I said, can I see your business plan, like normal documents, you know, or overview? And they're like, sorry, we haven't updated in a long time. Like we just have more investors than we need. So you couldn't even look at a whole overview or business plan, like flag number 1. Not impossible that it could be okay, because that does happen, but weird to start. Flag number 2 was, can I see your legal documents if I'm going to invest in it, like that I'm subscribing to, the operating agreement for the LLC and your private placement memorandum. These are legal documents they create. One of them is to actually form the LLC itself, and the other is normal risks and disclosures to investors that you would get in these types of opportunities in these structures. They said, well, you know, we won't provide those to you until you're ready to move forward. I said, okay. So then I said, can I come to your office? So I said, can I log into your machines and see all the transactions in real time? Because I knew well enough to know that with the processor they were using, one of the top 3, with my other operator, I actually had my own personal login to my machines real time. And they said, no, we don't provide those. And the truth is most operators don't provide those. So that was not a flag necessarily. So then I said, okay, can I come to your headquarters and see your machines on your terminals and show me all your transaction volume through Columbus Data, which is the processor that I knew? And they said, sorry, we won't do that for you. So like they wouldn't let me come drive 25 minutes away and show me their machines on their terminal. They didn't have a business plan. They didn't have a PPM. They weren't willing to provide any of this, and everything was going quickly, right? So, you know, I didn't know 100% for sure it was a Ponzi scheme, but I'll tell you, it wasn't a surprise at all.
Hey, so I'm actually curious about the PPM there. Were you in the, they were asking for money. Were you coming to them and saying, hey, I'm potentially interested in investing. Can you send me the legal documents? And they simply wouldn't send them to you?
Exactly. They said we won't share those with you until you make a commitment to move forward. So there may have been documents, but why I couldn't look at them was very odd. Now, what I suspect was going to happen is that they weren't going to have them, and they were going to make me sign some type of document, but they probably wouldn't have the same level of document that someone else would have paid for from an attorney that was actually registered with the SEC like you're supposed to, right? I think just everyone was
Right.
trying to pile into this because of the projected returns.
Were they asking, when they say commitment, were they actually asking you to transfer money before the legal papers were set? Is that what they were doing?
Truth be known, I didn't ask what a commitment meant because,
Okay.
like, when I'm weeding these people out, if something isn't kosher, I just move on, right? So
Yeah,
I wasn't
yeah,
going to push it,
absolutely.
but I loved ATMs and I was very close to their head office. I could just drive there anytime. So I was like, okay, just show me your ATMs, show me they're real, and they wouldn't do it.
Yeah. Yeah. I'll add my 2 cents on ATM funds here. I think from a business model, they're really interesting because, you'll put your initial capital into a fund like that. And then, of course, over about a 5-year time period, the ATM machines depreciate. Their value goes all the way down to zero. So you never actually get your initial capital back, but what you get instead is a huge amount of cash flow going all the way across, which makes up for it. And so it's interesting just from the accounting point of view of you don't get your original principal back, but you get a large cash flow the entire time. I don't know. Do you have anything to add to that?
Well, yeah, I do actually, because that's a very important point. So, when I first got out of the corporate world, just so everybody understand, I didn't have like $1 million to invest that made $100,000 at 10% cash flow that got me out of the corporate world. So what I did, and again, I didn't design it on purpose like this, but one of the ways you can supercharge your cash flow is by going into what you just described, which I call a fully amortized opportunity. So think about a home loan, right? When you take a 30-year fixed rate loan on your home and you pay that out for over 30 years, the bank is getting no payment at the end. So every payment you make is a combination of interest and principal. And the problem with that being on the bank side of the table is if the bank's living off of your money and they do this for 30 years, they have nothing left at the end. They've eaten through all their cash, right? Because they're getting a combination of interest and principal, right? If you invest in an apartment building, then the assumption is that you'll get some cash flow at a lower level, but then you're going to have a value in your asset at the end. So you're not eating through all your money. And presumably when you're done, you're going to sell the building and either get your capital back and possibly more, depending on how it goes, right? That's the projection. So it's very dangerous to live off of something like an ATM investment, because if you keep doing that, and let's say that you're, the bigger operator invests with a 7-year projected timeline. If you do that for 7 years, you got nothing left at the end. So I had a combination of what I call fully amortized investments like that to supercharge your cash flow, as well as amortized investments like apartments, for example, to have, less risk in terms of eating through all your money. You combine them and you have an average higher cash flow level that you can actually compound and reinvest quickly. That's what I did when I was early on to supercharge my cash flow. And then when I got out of the corporate world, I immediately realized I have to be very careful with this now that I'm living off of it. And I, over a 5-year period, gradually rolled off of less exposure to amortized stuff and more exposure to non-amortized stuff. So I wouldn't be eating through all my capital and ending up with nothing at the end when I was living off of it. So, but that is a trick to supercharge your cash flow. You can target more fully amortized opportunities like the ATMs.
All right. Does anybody else have any other questions here for Jeremy? And I want to ask, I'm sure there are a lot of people here that are just interested in like looking at the deals that you're talking about. Where can people go to browse or check out a couple of operators and what they're doing?
Yeah, so this is exactly the challenge, right? Is that, again, most of the opportunities I find are not to be publicly marketed. You cannot go anywhere and actually look at them. That would be illegal, per the SEC. So what you can do is there are some structures that allow people to market to what are called accredited investors only. And being an accredited investor is not being a member of any club or anything like that. It is either being at a certain level of income or at a certain net worth that the SEC defines. But if you're an accredited investor, you can log on to some of the crowdfunding websites that exist. Realty Mogul is one of them. There's many others. And I'm going to tell you right now, I'm an advisor for Realty Mogul. I've been an advisor for them since before they launched. So I'm just mentioning them because I know them. I don't do very much advisory work for them now. That kind of slowed down as of about 2017, but that's just one example. There's a whole bunch of larger ones out there. You can then register as an accredited investor and look at opportunities in your pajamas at 10 o'clock at night and see what these things look like. That's the best place to start to get access to them. But just know that Realty Mogul, like the crowdfunding platforms, are an intermediary. They have to make a profit. They have employees and overhead. So you have to take that into account. What Realty Moguls of the world are doing is they're providing people who don't have time to find opportunities that are interested in networking to find them, the opportunity to access them in exchange for a lower return because they're an intermediary. And there's absolutely nothing wrong with that. And that might be a great fit for some of you here, right? But just know that what I do is I go and try and find the opportunities directly and the sponsors directly because I don't want to have an intermediary when I have the time to find someone directly, right? So in order to find the opportunities I find, you just have to do a lot of networking, and it takes a while to build that up. One efficient way to do it is you can go to, there are now some in-person conferences that popped up over the past few years. Biggest one I'm aware of in this type of investing on the non-institutional side is the Best Ever Conference, which is going to be in Salt Lake City in March this year. There were 1,200 people there last year. So a fantastic group of people to network with, some of whom are actually operators you can meet who will have opportunities. But that is the hardest part of investing, is networking and finding opportunities in this type of investing.
All right. Any other advice you can give people that are starting out in this particular economy and want to get going on their own real estate adventure?
Yeah, so two pieces come to mind if you're brand new. One is, like I said before, make sure if you do not have your own opinion about where the real estate cycle is and where the economic cycle is, stop and educate yourself and formulate those opinions to start so you can decide the best timing and the best type of asset classes target for yourself to start, because you can make mistakes if you don't do that. And that's very, very important. The timing is very important of all this. The other thing I would say is if you're brand new and you're not sure where to start, my suggestion is to focus on one asset class first. Go with the one that you understand the best, the easiest one for you to learn. So if you grew up living in mobile home parks, I would literally tell you, go and look at mobile home parks first. You will understand those the easiest and get your arms around it the quickest. And the great thing about focusing on one asset class first is that I would say about 80% of the learnings of an asset class will transfer to any other asset class, literally, because in the end of the day, there's revenues, there's expenses, and you will learn about how those break down into real estate. And a lot of those go across the board. There's taxes, there's employees, right? There could be snow removal in certain areas, depending on what it is. There's heating expenses, there's tenant revenue. Now, that's the simple part of it, right? How that tweaks into a difference between a mobile home park and a self-storage facility and a retail strip center and an apartment and everything else, that's a 20% that you have to learn per asset class once you get the base foundation. So focus on one asset class first, learn it, dip your toe in if you think the timing's right, or when you think the timing's right, put your toe in the water, try a couple of deals in that asset class, and eventually start to learn a second asset class, because you're going to have that 80% of the foundation to do that. But don't go and try to learn multiple asset classes at once. That can make you scattered, and it's just going to make the whole process harder.
Pompey has a question that I missed here, and he wants to know a little bit more about how you do your background checks. I guess I would add to that, like, specifics. Do you go to a specific website, and what's it cost? And what do you look for?
So there's three different buckets you can approach background checks in, I would say. One is kind of random online websites. Those are the cheapest. I don't have any comment about it. I've never used them. I'm guessing some of them are legitimate, some of them aren't. I would be cautious for you to use them, but there probably are some good ones out there if you can figure them out, okay? Number two is you can hire a private investigator to do it for you. Now, I know that sounds like a movie, but private investigators exist, and they're licensed to be able to go run these, and that's how I started. When I first started, I called up a private investigator in California, and he was running these for me and providing me with reports. It's not cheap, but it's a very effective way, because not only do they run the report for you, but if they find something in the report, they have the experience and knowledge on how to go dig deeper into it to know if it's real or not, or what it is. And I'll give you an example of that in a second. The third bucket, which is the one I currently use and I've used for many years, is you can sign up with more of an institutional type of company the two biggest ones that I'm aware of are Accurint, ACCURINT, which is owned by LexisNexis, and TLO, like Tom Larry Operator, which is owned by TransUnion. That's actually the one I use. Those two are expensive. I mean, it's literally $75 a month membership if you don't even use the service. But they're very comprehensive. So when I use TLO, literally a friend of mine, it was a police lieutenant in LA, told him I was using TLO. The first thing he said to me is, oh, when I book someone and I bring them in, that's literally the first thing I run before I even use our internal system because it's so comprehensive. Like if I run a report on myself, it's 70 pages, okay? It just goes into depths you wouldn't ever expect. The challenge with it is that you may not understand all of it, right? Because if I had a speeding ticket and it doesn't say it's a speeding ticket, but there's a court case number in a certain county in a certain court, you have to go research all that and figure out, was like, did Jeremy just kill somebody or was he going 55 in a 45 zone, right? Big difference. So that's where starting with a private investigator can be helpful because you get to learn how all this works over time. But Accurate and TLO are the ones I recommend. They're just very hard to join. They have certain strict requirements. I won't jump into more of those details. You can check them out, but those are the two that are probably the best known ones that are really above board.
All right, we've got 1 minute left and one question left. Anna Marie is asking, what's your opinion about the remodeling business in this environment?
My opinion with remodeling at the moment is that I've been lending to people who, you're talking about remodeling and selling or remodeling and holding, or like you own your own home and you want to just put money into remodeling it. Do you happen to know which the question is?
Not specific.
Okay, so I'll just try to answer all those. So rehabbing a property and reselling it and flipping it is very dangerous right now because you're catching a falling knife. Everyone probably agrees prices are heading down. So you do not want to do that while prices are heading down, where you're literally not sure how long it's going to take you to execute on. The price of your materials could inflate during all this, and you may end up at a loss. That's not a risk you want to take. That's why I stopped lending to people who are flipping homes right now, okay? Even though I've been doing it since 2009. Renovating a home for holding it, different story. Hard for me to comment, depends on your circumstance. One thing that will be working against you.
A little bit of extra info here. She's coming from it from the point of view of they have a remodeling business and they're wondering if their revenues will decrease.
Oh, a remodeling business. I've been reading a lot that people who are choosing not to sell because interest rates are higher are putting money into remodeling instead. So there may be a decent future in the next couple of years for you, but I think the only way you're going to know how that's really going to pull through is to watch the recession unfold, if there is one, and see if that hits their pocketbooks or not. Access to HELOCs, access to credit lines during downturns, those all get more difficult. So it's a big question. I think there's going to be demand, but I don't know if there'll be credit for people to be able to do it or not.
All right, real estate education is obviously a great thing to do, and that's what we're about here in this group. Could everybody take themselves off mute and thank Jeremy for coming in and talking to us?
Thank you, Jeremy.
Jeremy, thank you.
Thank you.
Thanks, Jerry.
Thanks.
Hey, thanks.
Yeah, absolutely. Thank you.
All right, Jeremy, it's been contact details, right? I usually ask if you want people to contact you, Jeremy. I don't know if you do or you don't. Would you be willing to share your contact information?
Yeah, people can contact me, but I do want to warn everybody on end of year. I kind of do my books for the S Corp. I'm away for holiday, so you can reach out to me now. It might be better if you reach out to me in January if that's possible. But my email is my best way to reach me. I don't have a website or anything like that. I'm just very under the radar. I'm not looking to sell anybody anything. So it's my email is jroll, JROLL at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. And if someone just posted a question about the meetings that I was involved in co-founding, they're called, the meetings are called For Investors by Investors, or FIBI as an acronym. You can find them all on meetup.com if you're in Southern California, or you can email me and I could, depending where your location is, I could tell you the closest ones to you.
All right. Thanks so much, Jeremy. Hope you have a wonderful weekend.
No problem, guys. I'm really sorry about my camera. I don't know what happened.